there's cyclical inflation and there's monetary inflation. And I think that people are not looking, and the Fed is not adequately looking at the fact that when there's a lot of debt and you create a lot of debt and money, which of course is a great stimulant, also one man's debts are another man's financial assets. As the debts rise and they're somebody's financial assets, there's a balancing act that becomes increasingly difficult. And so when we look at what's ahead, we do know how these cycles work. We know that you have a recession to a recession, and on average they've been about 7 years, and they're shorter when you start quicker. And so we're in a cycle where there was a lot of money and credit. I mean, from an investor's point of view, think about how bad that debt is. I'm holding cash. Last year I lost 7% to cash. One would have lost 7% in buying power. And now if you have a 5% inflation and so on, the things are changing. And so because they're changing in that way, inflation psychology is going to change. They don't want to hold the bonds, or they don't want to hold the cash, much less. And so we have an extra risk that they may sell those bonds and that cash. And when they do, then that creates a bigger deficit in funding, because not only do you have to sell the treasury, what the treasury has to sell, there has to be enough buying to buy what the sellers are selling. And when that comes up, it puts the central bank in the position of either having interest rates rise a lot, and that shuts things off, or having to come in and fill the gap in a bigger way than it was done before. So we, as that psychology changes and wages change and all of that, we are on the brink of that happening. So yes, we have a big issue pertaining to inflation. The trade-off, it appears to me, that a high enough interest rate to adequately contain inflation of what we might think is adequate is too high of an interest rate for the markets and the economy. So that the trade-off that the Fed is going to face will be an even greater, more difficult trade-off between inflation and growth. Think about it. The tightening that might be priced into the market might take it to 2%, maybe give or take a bit. 2% interest rate, when you have something that could be a 5% inflation rate and you have the supply-demand imbalance, is something that is really a problem. Almost any prospect is you're going to have a much higher level of inflation than you will have an interest rate. And when that happens, you're going to have continued losses in buying power, and that's not going to be palatable. I think that the Fed's forecast that it was transitory was obviously wrong. Okay? I think they are misunderstanding things. I think they put too much on the cycle, a normal cycle. Why are real interest rates, since we started, when we started setting inflation index bonds, they were 4% real. Okay, how did they get to minus 1%? Why is the equilibrium in interest rates 500%, 500 basis points lower than it was back then? There's something bigger going on. And that bigger thing that's going on is the accumulation of debt, because that's buying power. That's stored buying power. So everybody's got to believe that that stored buying power is real. Yet if you think about how are you going to get that? Can everybody sell those bonds and actually convert that into purchases? No way. So if you look at history, throughout history, there's this bigger thing that's going on, this bigger debt cycle thing that's going on. And so I think there's not enough attention paid to that.